Welcome to the Property and Coffee Podcast. I'm your host, Matt Atkinson.
I'm Matt Skehan.
We'll be fueling your financial future one coffee and property insights at a time.
Helping you navigate the property market like a pro.
Hello, and what a pleasure it is to have your company on the Property and Coffee Podcast. We're going to be fueling your financial future one coffee and property insight at a time. I'm your host, Matt Atkinson, joined by Matt Skehan. Firstly, Matty, Happy New Year's. Today is the 1st of January, first day of 2026, and great to be in the studio here recording with you and having a bit of a look as to what's happened in 2025 and some insights into the new year. Welcome.
Thanks, Matty. Yeah, I can't believe it's 2026 already, so 2025 flew by, so looking forward to a bit of a wrap up and looking for what's ahead. It's exciting.
Well, that's it. And as we know, we can't predict everything, but I'm sure it'll be exciting with a few tales in the property world as we get into the year. So today is a little bit different. You'll notice we don't have a guest with us. Matt, what you and I are going to be doing, we're just going to be having a bit of a look down memory lane on some of the property themes in 2025 in Australia. And then we're going to be looking at some things that might be on the horizon that might be coming up in 2026. So just to touch on those, we're going to be taking a look a bit around overall market performance in the markets, interest rates. There's been a bit of a story there mixed in with the RBA, impacts of migration, and then looking around from an investor perspective, rental rate growth and also onto the rental yields. So let's get right into it. First up, market performance and values. So, Matty, there's maybe a couple of different tales to come out of the Australian markets. Can you just talk us through, first up, what are we looking at from a best performance perspective in our capital and then also our regional markets across Australia?
Yeah, so through 25, according to Cotality, we had sort of 7.5% growth across the board at Australia level. So 7.5%, which is, sort of double inflation across the board. So it's a pretty healthy and strong result. So combined capitals around that 7.1%, and regionals actually did a bit better at 8.6%. So the standout market was Darwin, across the board. So that was sort of looking at 17% growth, which is that's some significant numbers, and then
yes.
And then followed by your Perths and your Brizzies, which is in the 12s and the 13% across the board. So your Sydneys, your Melbournes, your Canberras, more in that 4 to 5% sort of bandwidth. But like I said, it's markets within markets. I know looking at some of the Victorian data, some of those suburbs, even Frankston North, I think for houses got 20% growth, and there's a couple other suburbs around Frankston, Seaford, and those areas that snag sort of in the teens as well. So like anything, data's good at a high level, but there's a bit of that micro or data that you can unpack a little bit as well. But in terms of the performance, so it really, as you probably would have observed, it was driven by that affordability. I think, with obviously rates, the cost of living and all those sort of things, the affordable markets sort of tended to perform better. And that's what we observed on the ground as well, that affordable price point, particularly in that sort of 1.34 in Melbourne was really, really competitive. And with the grants and incentives, that was really strong and healthy competition in that market.
Yes.
And sort of that, as the price point went up and higher price points, probably a bit softer, a bit patchier, I think, as well. So some of the stronger areas were clearance rates were a little bit patchy across the board and a little bit hit and miss. So it was a tale of, I think, affordability and sort of yield as well, right? Some of these markets they've got some strong yields where cash flow was important, was driving that sort of growth across the board. So. Yeah.
Well, that's good to hear. And as you say, like everything, there's high level data, and then when everyone would be looking to buy, whether that be within the suburb they live in or looking to invest, you really do need to interrogate that data a little bit more, speak to some of the experts on the ground. And as you pointed out, and obviously each state would be a bit different, but once you go above a certain price point, it might be an opportunity where you've got someone like yourself on your team, you might be able to negotiate a bit of a better price, just because the competition standpoint might be a little bit less. But great to hear that the market's ticking along at about 7.5%.
It's a healthy year, isn't it, for 25? So yeah, well, it's setting up well. So
we'll see how we go in 26, but hopefully more of that to come.
So moving into the interest rates. So So, Matty, talk us through the RBA rate cuts in 25 and sort of what, the last meeting in December. What's sort of the sentiment? What's the sort of pulse check? And I suppose what's the sort of vibe going into as we kick off 26?
Well, let's first start with the rate cuts. Obviously, I think across the board, those were welcomed in terms of getting some cuts.
I was appreciative of those. It helps with the cash flow. That's always good.
No, that's it. So putting some more, I want to say, cash back in people's pockets, but ultimately reducing some of that borrowing cost burden. As part of that, what that does do, everything being equal, people's borrowing capacity would increase, and typically that gives buyers a bit more confidence when they're going out to buy, potentially that they're buying in a market where debt is remaining steady or potentially becoming a bit cheaper. And I'd like to think that's a bit reflected in terms of what we've talked. That's fueled a bit of that price growth, but also people having the confidence that they're happy to go out buy their home that they're looking to move into, or potentially look and purchase an investment property. Where we ended the year, I think if we go back to some of the economists' comments early on in 25, there was talk of potentially further rate cuts or towards the end of the year, whether that be one or two, and potentially more at the start of 26. That, like economists, that might have differed slightly depending on what bank you spoke to. But where we seem to have ended up at the back end of 26 is that there's a bit more of a cautionary approach, as by the last Reserve Bank meeting held on the 9th of December when they did their release. And I might just touch on one or two things that they've come out with in terms of what's driven their decision. And this will be a good space to watch for 26 as the year slowly kicks off. So they've highlighted a few things. One, inflation's come down since 2022, which is great, but that there's obviously been a little bit of an uptick in there. They do want to retain it within that band of 2 to 3%, and so that is something they are watching, and that data will be continually reviewed and really sort of interrogated at each board meeting, and will be a focal point for people looking to understand what that means for the economy, but also just around where we look at it from the property perspective. Labour market remains tight. There's also they've highlighted the fact that there's also the financial conditions of ease. So things, obviously, what we've just spoken about, the fact that rates have come down a bit, debt's become a little bit cheaper. People have some confidence, which then people may be spending a little bit more. So what they've where we've ended off with is to say inflation's a little bit high. There still seems to be a bit of volatility. The labour market's also still tight. So it's very much a cautionary approach to say it was a hold, and let's see what 2026 brings. Things probably to think about at a high level is, again, there's going to be a number of factors going on in the domestic economy which may influence this. We think of prices or your price of goods basket, what's happening in the labour market, and ultimately also inflation. But we also should be aware that there might be factors external to Australia which might have an influence around what happens in the local economy. So we hope we don't see any of it like it, but you think of like some of the wars which might impact energy prices, might have an impact around our economy. So we'll watch the space, see what happens on the international and domestic front, but hopefully a few more good news stories as the year progresses.
Good news will be great, Manny. So
one of the pillars of ultimately Australia is around the fact that it's a country that people would love to come and work and live in, just based on work-life balance, the job opportunities, but also, it's a beautiful country to live in and just explore. So we've seen in 25, there was a strong net migration that came into Australia. We noted obviously down here in Victoria, there was a, relatively speaking, around how many people came in, a fair bit came down to Vic. And look, we haven't seen any necessarily material policy changes, but we'll probably expect that to continue in 2026. Can you just break us down a bit more on that, around what net migration means just in the property space?
Yeah, no, 100%, Matty. So yeah, migration, obviously, properties, supply and demand are the two big fundamentals along with sentiment. But overseas migration, firstly, affects the rental market, because obviously people when they first come here need to live somewhere, obviously, and often it's near jobs or family or other areas as well. So firstly need, roof over the head and shelter. So putting pressure on that rental market, which you're observing as well. I think we'll talk about rental rates in a minute, but there's been some, tightening across the board as well. So that, there's immediate sort of, if you're an investor, that's a positive thing, right? Like the supply and demand in your favour. So firstly, you've got that rental, uptick, and then longer term, it flows into sort of the buy side as well, right? So people can't generally just come in here and buy straight off the bat. So again, it's that rental side first, and then longer term, flowing into the buy side as well. So again, it's migration's our sort of it's a fundamental need, isn't it, for our country and stuff? We've got to bring in more workers, aging population, and obviously taxpayers, and obviously big country as well. So that's obviously topical at the moment, but it's definitely something that's affects the property market in a few different ways, right? And obviously then you combine that with we're behind on the building targets as well. So again, that supply and demand sort of mismatch and alignment there as well. So I think there's a interesting space to watch, but it underpins some of those bigger markets too. I know even Melbourne's had since the COVID days really had a strong renaissance, I suppose, in migration, even from affordability constraints too, right? Compared to some of the other capitals that have performed really strongly from a rental side as well, and like Southeast Queensland and stuff. We've seen a little bit even reverse migration. I know we've observed that a little bit as well, where people are come back, or for family, or for schooling, or for affordability as well, jobs, or other reasons too. So interesting space.
Humidity.
Humidity. I don't think I want to be spend a summer up in Queensland. Great place to go holiday and visit, but it's a very different place.
That's it. You got to be built a bit different to live there all year round. But as you say, beautiful place to go and visit, and obviously if you want to live up there, it's a beautiful part of the country.
Amazing lifestyle. So moving on to the sort of next theme, which is around that rental rate growth, Maddie. So really keen to sort of hear a bit more about how that rental market has performed over the last 12 months or so. So I know there's a bit of interesting data that's come out, and keen to unpack that a little bit more.
Perfect. Well, what we'll do is we'll start a little bit with some numbers, just so people can we can give some context around what we're referring to. So just to bear in mind, inflation's probably in that 3 to 4% band.
Yep.
Obviously, the target is governments, so RBA, they focus on getting that back down to the 2 to 3%. Whereas rental, and this is having a look at the, across Australia nationally, growth was at 5%. So we can see, in terms of slightly above that inflation number. But again, probably a bit of a tale of two parts, and for good reason. So we're seeing the combined regionals in terms of that rental growth is a touch over 6%. And then the capital's tracking a bit under at about 4.5%. When I say a bit under, probably on the other side. So across the board, even if you sort of break that up broadly, that rental market is growing. And probably a couple of things to underpin that. I know what we just talked about, the fact that supply is constrained, generally speaking, across the board. So landlords are able to either retain their price or potentially, with inflation, look to increase that year on year. People are happy to pay that because, look, it's, if they don't want to pay that, they might be struggling, or they might be moving to something, paying more, and maybe not getting the same quality rental that they were after. Just also probably to highlight, although we've had debt potentially come down slightly, let's not forget landlords. That's not where their cost stops. They would also be picking up landlord costs. So think about property management fees, land tax, depending on where their property is located. Yep. I think that's obviously something people are a bit more aware of. And then, as you pointed out, right, we've got a bit of they're looking, and they've got the demand. People want to ideally make some money, but recoup some of their costs and try to keep that on an even keel. So although that rental growth has been strong, you'd also, as landlords, would look to make sure that there's additional cost burden there that they're looking to make sure that they can recoup or sort of net out. I might just touch on some of the numbers there because, again, a bit of a tale of two different paths in terms of where the rates have grown. So probably to highlight, in terms of what we touched on earlier, where the actual value of properties have gone up, is probably not too dissimilar. So we're seeing regional Western Australia. So we're seeing that rental rate growth up at 9.5%.
It's strong, isn't it?
Which is almost double
digit,
what we're seeing as from an average, the national average. And then having a look at another regional hotspot is Darwin. So that's up at 8.6%. So they're probably our leaders in that space. If we look more and take a bit of a view on our, call it capital cities, Sydney's slightly below the average at 4.7. We've got Melbourne at 2.3, which I think we'd probably say we'd expect that to be a little bit higher. But again, you probably break that down depending on what suburbs you look at and where the growth is.
It's a big city, right, isn't it? So you get some
data
points.
Quite different. So, across the board, tracking at 5%. But again, depending on how you're looking, where you're looking to invest or what properties you're after, bit of two different tales there, depending on if you're looking regionally and then also looking for a bit more around the capital cities. Maddie, the fifth theme that we're going to be touching on is around rental yields. So any investor, when they're looking at a property, you'd want to understand, one, what's going to be your income, your expenses, and try to work out, especially with property, what's the growth? So what's your return going to be? So two things that will be good to break down. One, just explaining to people what rental yield is or what that means when we refer to it. And also, with the totality data that we've got available, what that means. So what are we seeing in that rental yield across Australia? And let's maybe pick out one or two pockets we can speak to.
Yeah, cool, Matty. So firstly, rental yield is normally we talk about it in a gross context. So it's your weekly rent times by 52. So sort of your annual rent, and you're dividing that by your purchase price. So that gives you a gross rental yield. So it's a good calculation, so you can sort of compare apples with apples. We don't sort of do a net yield because obviously there's different fees and charges, and every state's different, right? I think we talked about, even some of the tropical climates obviously will have higher insurance costs, and if you've got a unit, you might have strata and things. So that gross is just keeps it on a level playing field. So it's just a good metric for that sort of
almost a bit of a rule of thumb in terms of to sort of compare apples with apples, broadly speaking.
Yeah, 100%. And I think it helps as you know, we move as a broker with the finance as well. When you're doing your numbers and for your pre-approvals, it's sometimes you've got a minimum sort of yield target you've got to hit as well. So for our clients, I know that's something we need to focus on, making sure that we're achieving that just to satisfy the finance they need as well for their purchase. So, but yeah, just going around the grounds, like the average across Oz is 3.6%. So that's as a rental yield. So 3.6%. So capitals around a tad low at 3.4%. The regionals are 4.3%. So I'm unpacking a few of them. Across the board, you've got Darwin at the top there, which is again no surprise at 3%. So that's sort of leading the pack again. And then you sort of go into it's a little bit logjam. Sydney at the lowest there at a 3%, and then up to the 4.3s and the Darwins, and the Hobarts. So you've got a bit of a mixture across the board. So you've got Darwin out the front at the moment, and looking at the regionals, you've got again regional NTs sort of pretty strong at almost 8%. So that's sort of leading the pack at the moment from a rental yield front, and then the rest of the regionals in that 4.5 to sort of 5.5% across the board. So what all that means, it's important to understand the yield because obviously you've got a mortgage rate, and obviously that's a fixed cost, and obviously just understanding what your cash flow or your return is coming in from the rental side. So
perfect. And probably one thing that's last to point out to say, obviously rental yield's important to be aware of, and when we're looking at a property. But I'm sure we can attest, especially when the more metropolitan regions where it's a bit more mature, there's obviously not the only factor we want to consider when someone's on that investment journey, but also what's potentially the capital growth. Capital growth potential.
Mm-hmm.
Because again, is that all equal across the board if we look at different cities?
No, not at all. Not at all. So again, I know it's very important. So for our clients, you're obviously looking at your growth is important, yield. Another one is obviously vacancy rate, and even things like quality of tenant as well, and the demographics and
yes.
What's driving the demand and the gentrification in those areas. So again, it's got to be looked at holistically. You can't just go, you can't just look at the magazine or online in the book and go, that's a fantastic yield. I'm just going to, throw my money there or throw the data at the board. It's sort of got to, again, unpack that data a bit more, but it's good to have it as a high level, give you a bit of a guide as well. So But no, it's a good question. There's always, as you know, multifactorial approach, and everyone's different. Some people are needing that growth, that equity in the early days, and then in time, it's more that balanced assets than chasing yield, debt reduction. So it's all horses for courses too, and depending on where you're at in your cycle of investing as well, and age profile. So.
That's it. I mean, look, great data to have at our disposal, but as you say, it's important that depending on what your investment strategy is or what you're focusing on, how do you unpack it to make sure that it makes sense for you, not just at that high level number.
Yeah, correct. So Matty, so why those yields are important? So I think we're going to talk through a few examples here, but why are those yields important to the investor? Why do they need to factor those into their consideration?
Yes, so maybe drawing together some of the items we've talked on and we'll run through some numbers here. Is we just want to understand, if you're investing, what's my cash flow? Is it an inflow? Is it an outflow? And then obviously there's a tax component on part of it. So if you go ahead and we purchase this, put down a deposit, what does that potentially mean for us? So what I've done, we've got two examples we're going to touch on. The first is just on Melbourne, and then we're going to have a look at a bit of a regional town, or so regional location. So if we just take a look at Melbourne, and we're going to just use averages here. So I just want to bear that in mind that, again, this probably doesn't speak to every suburb, but at least it gives us a bit of a flavor.
It's just a good guide, yeah. So
if you take the Melbourne average house price, we're going to call it, it's just touch under $1 million. So we'll take $1 million. Your yield that we're just quoting there is about 3.6%. So we're getting, gross rental income in of about $36,000 per annum. Assuming we put down a 20% deposit and we do a loan term over 30 years and it's principal and interest, we're looking at repayments of about $55,000.
Is that including the principal, Matty, or is that as well as the interest?
Yeah. So that's including the principal. So just really, if you were to punch that into any loan calculator, broadly speaking, that's what you're going to come up with. What that means is we've probably got a bit of an out-of-pocket here of about $19,000. Look, and that's obviously before deductions such as repairs and maintenance, land tax, and letting fees, etc. So if we look in Melbourne and just put that on a sort of a scenario one, you're seeing there's a bit of a loss just on the average call it house. If we were to take a look at something in the Northern Territory, so your average house price there, we're looking at about $375,000. Your yield was at 7.9%, which translates from a gross rental income to $30,000, which is fantastic, just based on a high level number. And then again, your repayments, assuming you put down a 20% deposit, we're looking at about $20,500. So just at that high level, if you look at those scenarios side by side, we can see quite clearly, the Northern Territory, those numbers look a bit better. You're sort of positively geared before we sort of get into any of the deductions.
Yep.
But again, coming back to what we've discussed, while it's an important one to consider at the high level, we need to dig into that because, one, Melbourne's a bit more of a mature market. So, also the price is a bit higher. So naturally your yield as that price goes up, does drop. But again, you would need to look and say, well, okay, is the only thing we're chasing rental yield? Because what is our capital growth opportunities in Melbourne? What's the strategy of the person buying, even if it is their own home? Whereas up in the Northern Territory, again, that price point's a bit lower, which means that ultimately with a higher yield, your difference is going to be slightly lower. But is it going to be looking at the same capital growth? Is that what you're chasing, or are you wanting something where there's a higher yield and it's just more positive cash flow? One thing else to highlight, different places are probably prone to different weather events. So
correct.
What does your insurance look like? So although you might be positively geared in the Northern Territory, your insurance costs might be quite significantly different to if you were down in Melbourne, as an example. So although it's great at a high level, as we can see, two different tales in terms of looking at a metro capital and then looking at something a bit more regional, you really do need to unpack all the factors. And if it's something that you're not 100% comfortable with, by all means, speak to someone that is in the know, because it is important to get that full picture. Because especially property you're looking to do a long-term investment. So you want to have that view as to what that's looking like over the next 2, 5, 10, 15 years, and just make sure long-term that is the right choice. Because sometimes something in the short term looks really good, but if you look at over how it's performed over a longer period, it might be might not be what you think it is.
100% echo that completely. Property is a long game, right? It's not a get rich quick scheme, so it's sort of get rich slow, and it's sort of the entry and exit costs are higher, so you want to sort of speculate, I suppose, right? You sort of, and then everyone's risk profile and appetite's different too, right? So,
No, 100%. Well, just in summary, let's recap a couple. We've had a couple of those different themes that we've spoken through. As you said, 25's been an interesting year, quite a bit going on. We seem to, as I said, we've started the year, number of rate cuts. We had some growth stimulation. People had a bit more cash back in their pockets, a bit more borrowing capacity, which is, we'd like to think, probably contributed to that bit of the lift in prices, and also just a bit of confidence. We're seeing strong rental growth, and also immigration factoring in positively there around probably driving up a bit of that rental rate growth, but also probably a little bit on the housing supply crisis contributing a bit towards that. Maddie, as we close up 25 is closed, but as we look forward to 26, what are a couple of the key things you would like to call out that we should be, or our listeners should be aware of?
Yeah, no, thanks, Matty. So yeah, into 26, I think a few highlights I sort of think worth sharing. So the affordability trade-off, so is king at the moment. So I think there's definitely going to be, as we've talked about with rates and the sort of the economic sort of factors as well. I think that is affordable markets are still going to be driving and performing well. So some of those regions and areas you've got to look at that. What is that affordability matrix as well? Because I think there is that interest rate sensitivity out there as we know, right? So I think that affordability again is still going to be the tail of the driving the market forward. Secondly, rents, again, there's no real reason for them to drop. I can't see it all, right? They said that we're behind on houses, population growth, and those supply and demand sort of metrics as well. So I think rents are going to still continue to rise, and we're observing that on the ground as well. We're talking to property managers, and well-located properties are in demand and multiple applications, and they're not sitting vacant for very long at all. So I can't see that changing in the foreseeable. So that's a positive if you are already a landlord. If you're wanting to get into the market again, it's another reason to get in, so you can get that sort of growth in there. In terms of rates, I think you touched on that earlier. I think there's we're in that pausing cycle, aren't we? Right, wait and sort of see approach. Like I think gone are the days of expecting multiple rate cuts anymore. So yes. I think it's more going to stay steady and stay and stay consistent for a little period of time as well. So I think in summary, again, it's as we know with property, I think people who are waiting for the crash or waiting for the boom, I think it's just now's your time to take action, right? You're sort of aware of all the different factors, but I think as you're having your break over 26, if you've been wanting to get into the market, now's as good a time as ever. You can't see prices going backwards in the foreseeable future as well. We're seeing what's happening with rents, and even if we even get some moderate growth, over the year, but for me, I think it's going to be another reasonable year for the market. Again, it's the old safest houses analogy is probably going to play out in my opinion, and so yeah, good time to take stock and look forward to the year ahead and look and see if your cash flows allow it. Now's as good a time as ever, right? There's some great incentives out there for different home buyers in different markets, and you can capitalise and get in and before the prices get away from you.
100%. Look, as we know, the Australian property market waits for no one. So be aware and transparent of what your position is, and be intentional in terms of what you want your 2026 journey to look like.
100%.
Thank you. Thanks for joining us.
Thanks, Matty.
If you would like to keep receiving property insights and golden nuggets from our guests, please do follow us, and you'll get the latest episode released on a fortnightly basis.